Okay, so you've had a chance to have a look at this question, Semstone, which dealt with the transfer of property from PPE to investment property. Let's debrief. So we started the beginning of the year with some PPE, and I cheated a bit. I didn't go back and do the reval properly, so I don't have a box. But otherwise, my numbers are correct. So at beginning of year, I had done a revaluation, so my land and my buildings were carried at reval. I am missing the box that would normally appear here, that would have cost and ACDEP, because I was too lazy to go back and rework the reval backwards, because you had to work the reval backwards to beginning of that year. But it's fine. It's a starting point for this question. It's good enough. So as a starting point for this question, my building and my land were at revalued amounts at beginning of year, 790 and 3410. I need to depreciate that building to beginning of year, not to beginning of year, to the date of the transfer. The asset use changed 4 months into the year. If we look at the information, it says they decided to rent out, and a 3-year lease effective from 1 December was started. And they've given you the dates of the, sorry, that wasn't 4, it was a 9 months. They've given you the dates from 28 Feb to 1 December, which was 9 months. So halfway through the year, not halfway through the year, 9 months into the year, they decided that they were going to change use. I don't really like the way that they've spoken about use here. They didn't say when we stopped using it. They talked about when we started leasing it. But really, we're looking at change in use, not change in lease. So when I stopped using it and my intention was to lease it, at that stage, it would have been investment property. So what I need to do is I need to depreciate for 9 months, and I need to work out remaining life in order to be able to do that. So if I look at remaining life, I have to start off with the months from acquisition. So I start by looking at from acquisition date to the first year end. And acquisition date in the question was the 1st of August. So from the 1st of August 05, August, November, December, January, February, the building was available for use. August, September, October, November, January, February. August, September, October, November, December, January, February. Oh my goodness. I keep leaving out months. August, September, October, November, January, December, January, February is 7 months. There were 7 months in the first year, and that would have got us to February 06. Then from February 06 to beginning of year, February 7, 8, 9, and 10, it's 4 years to February 10, which is beginning of year. I need to get from 1 August 05 all the way to beginning of year, February 10. And that is 7 months for the first piece of a year, then 4 years, 48 months. It gives me 55 months altogether. My life of my asset was 420 months. I work in months when I have pieces of year. They told me that the life of the asset was 35 years. So 35 times 12 is 420 months. So therefore, at beginning of year, remaining life was 365. If you got this wrong, then your calculation would have been wrong. The rest of your calculation would have been wrong. So remember, with PPE, especially buildings, where there are long useful lives and we work with months, it can be tricky. You must be very careful with that calc. So at beginning of year, I have 365 months of remaining life and a residual value of 500. So I have to depreciate for 9 months from beginning of year till the 1st of December for 9 of the 12 months. And so my depreciation works out to 71753. 3410 minus 500 divided by 365 times 9 is that calculation. 3410, carrying amount at beginning of year, less 500,000 Rand, divided by 365 months remaining life at that stage times 9 months gives me that depreciation. I know that I must transfer this property on the 1st of December, and I have to transfer it at market values. So it comes out of PPE, goes into investment property, and remember that it comes out of land and buildings and goes into one column, land and buildings, investment property. So the two numbers come out and come in on the 1st of December, and my balancing figure then to balance the numbers is my reval. That reval will go to OCI and will go to reval surplus, and it's a reval of 60 for the land and 161,753 for the building. So I started with a building with a value of 3410. I depreciated for 9 months, 71.753. I then revalued it by 161,753 to get me to 3.5 million rand, which is the amount that I then transferred to investment property. So this is at 1 December. At 28 Feb, which is the year end, they say to you that the fair value of that property is 4460, and so therefore I have a fair value adjustment of 110. Let's have a look at, I don't know if I've got the solution for this here. I do. So let's have a look at the solution. This is the investment property note. Let's start off with the PPE note. Is it here? Here's the PPE note. So you see it starts with building of 3410, and they've got a gross carrying amount and a ACDEP. You needed to have worked backwards to get those numbers. There's the depreciation, the reval, and then the transfer out, which should both have brackets, to investment property. We then look at the investment property note. The investment property note looks just like the PPE note. It has the same type of information, carrying amount at beginning, transfer, fair value. It's a movements note. It's got the movements in investment property. You'll see that they've put land and buildings columns here, grayed out. I think it's supposed to indicate workings, but I wouldn't do that in the exam at all. The investment property note doesn't have different categories of property. It just has one column, a total column. And so for my total column, carrying amount at beginning was 0. There was a transfer in of 4350, a fair value adjustment of 110, and a balance at the end of 4460. There's also this story, which we did see in the PPE note, which again needs to be put in for the investment property note. It's the story about the reval, about the fair valuation, and the fact that it was done by a sworn appraiser. Okay, so that's the disclosure for investment properties. I wonder if there's some PPE, no PBT disclosure for this one. All right, let's talk tax. We already did tax for PPE. And you know that in PPE, we talked about the fact that tax realizes through use. Yeah? And so therefore, when tax realizes through use, we used a straight 28%. And if you recall in PPE, the only exception we had was land. We said land can't be used up, so land is not 28%, land is 66.6 times 28, which is capital gains. So now we looking at investment property, and investment property is different. IAS 12, which is the tax statement, was amended, and the tax statement says that there's a rebuttable presumption. It's presumed that, and rebuttable means that you can question that presumption, but it is presumed that investment property realizes through sale. Realizes through sale. What that means is that there will be different tax implications, because if I'm assuming that deferred tax realizes through sale, then what happens from a tax perspective is that there is a recoupment and there is CGT. The recoupment would be up to cost and the CGT would be above cost. So for deferred tax, if I sell property, there's a CGT implication. And so when I do deferred tax for investment properties, my calculation needs to look like this. I need to split the value of my asset into the cost piece and the above cost piece, yeah, which you can see over here. So if I use that previous example that we had a property that had cost 3750. Let's just go back to that property, to the question. Here is the building. It had cost 3750, and at year end it's in my books at 3560. Sorry, is that what I have? 4.5. I'm dealing just with the land. I started just with land and then landed up with property and everything mixed up. But let's just work with these numbers and assume those are the numbers. So I need to take my asset and I need to split it between cost and above cost, or reval. Then on the cost piece, I will go back to I will need to compare that with the tax base. And for this question, I've assumed that the tax base is 3 million. And work out a normal tax of 28% on that. So whatever I had as cost, whatever SARS has given me as allowances and reduces to a tax base, that difference is normal tax, normal CGT, normal deferred tax. And then the remaining piece, the above cost piece, that piece lands up being no tax base and ends up being then at CGT. So when I do deferred tax calcs for investment property, I must make sure that I do this split. Below cost, above cost. Below cost, if there is a tax allowance, there'll be a tax base, and then that temporary difference will be at 28%, normal tax. Above cost, there's no tax base because SARS doesn't give us any deductions above cost, and so the temporary difference will be a capital gain difference and will be calculated at capital gains tax at 66.6 and 28%. So remember, deferred tax for investment properties is different to deferred tax for PPE, just for the building. Land was the same in in PPE as it is in investment property. So just for the building. So for the building, I'm going to have to split cost and above cost. Below cost, it's normal tax. It realizes through use. It's 28%, or it'll be a recoupment. Yeah, there'll be a recoupment if it's through sale, a recoupment, and that's at 28%. Above cost, it's capital gains tax, so it's CGT 66.6 and 28. Okay, let's have a look at the deferred tax in that question, the one that we just did. Sorry, I think it's below here. So this question that we just did had land, and it had. Here's an example of a question with land and buildings. Property 1, land. Property 2, land. Sorry, I think what I wanted to show you was but let me show you that deferred tax calc, investment property. So there are two properties in this case, and there's your temporary differences, and you can see that your temporary differences is just your fair value adjustments. So there's your fair value adjustment, and there's your temporary difference, and it's taxed at 66.6, and down here is your fair value adjustment. There's your temporary difference, and it's at 66.6. Yeah. They record the initial cost of the land as a tax base, but it's not a tax base, right? The initial cost of land is not a tax base. The tax base is 0, and the difference is actually an exempt difference. It's not that there's no temporary difference. There is a difference, but it's an exempt difference, and there is no tax base. So that would be a more correct way to show it. I wanted to just also touch on this additional disclosure for investment properties, and that's the profit before tax note. In the profit before tax note, you must show your rent received and your fair value adjustments, but that's something that you probably would already know to do from second year. Any rental income needs to be disclosed, and any fair value adjustments on your investment property need to be disclosed in your profit before tax note. But then this is maybe where it's important, and it's a little bit different for investment properties. We disclose expenses on investment properties, and we distinguish between direct operating expenses that generate rent and direct operating expenses that don't generate rent. So if my property was empty for part of the year, then I would distinguish that disclosure, those expenses from the other expenses, and I would have two lines here. One line that would say direct operating expenses that generate rent income, and one that says direct operating expenses that doesn't generate rental income. Okay, so that's investment property. Let's do a quick overview before we do the assignment question. Sorry, I'm trying my best to go all the way back here. So investment property is any property that's being held for rent appreciation, for rent or for capital appreciation. In other words, not held for use. Investment property is the same as PPE up to subsequent measurement. So when we look at subsequent measurement, our options then are cost, which is the same as PPE, or fair value. If we use fair value, we have to do fair value every year, and the fair value adjustment goes into my P&L. In terms of presentation and disclosure, in the SFP, it's a separate line. And there's a note, an investment property note, which is similar to the PPE note, except that land and buildings are together in the investment property note. Then in the P&L, rent income is other income. The fair value movement could be other income or other expenses, depending which way it goes. And then in the profit before tax note, we would show the rental income, we would show the fair value movement, and we would show the property expenses. And for property expenses, we separate those into the ones that earn rent and the ones that don't earn rent. Transfers in and out of investment property, the rule is to remeasure first and then transfer out. So in PPE, I would first revalue, then transfer. If it was, so here it is, first revalue, then transfer. If it was in investment property, I would first do a fair value adjustment and then transfer. That new transferred amount becomes my new cost in PPE. But usually what we see is this first scenario, PPE becoming investment property, but it could happen the other way to where investment property becomes PPE. We then looked at an example of a transfer, and then we talked about deferred tax. And deferred tax for investment properties realizes through sale. The sale implications of tax is recoupment at 28%, which is up to cost, and then above cost, CGT at 66.6 times 28%. And so when we do our calculation, it's important that we split our number into the above cost piece and the below cost piece. So start with your amount that's in your financial position, and then split it into cost and above cost, so that you can get your split between what would be recoupment on sale and what would be capital gains on sale. And the reason for that is because IAS 12 has that presumption that investment property realizes through sale. All right, so we are ready to complete. I then showed you some disclosures, which you need to know what those notes look like. The important one is this one, the investment property note. Remember, it's one column. It's a movement note. It's a difficult note to know. It's on page 123 in your study guide. So I would go and flag that one, investment property note, page 123. And then the other note that's important is this one, the profit before tax note. It's on page 110 in your study guide. Profit before tax note showing the rent, the fair value, and the operating expenses. If they ask you an investment property question, they could just say disclose in the notes. If they do that, you have to prepare both of those notes. All right, so then we move on to our assignment that we've been busy working on. And we have so far covered everything in this assignment except for this shopping centre. This shopping centre is an investment property. If we read the information, they purchased the shopping centre on the for 23 million rand, and they give you the split of land and buildings, land of 10, buildings of 13. They purchased it on the 1st of May 2013, and they purchased it to be leased. So when they purchased it, it was investment property. The fair value of the property at year end is 26.5 million. So there's been an increase in fair value. We don't need to worry really about the split between land and buildings, except when we do the deferred tax. So the split of the numbers is really just for deferred tax purposes, so that we can get our deferred tax correct. If we look at the required, they tell us about the buildings. A 5% building allowance on both buildings. So both buildings are getting allowances from SARS. So there will be two pieces. If the building gets sold, two implications: a recoupment of the building allowance and then a capital gains tax. Deferred tax is on all differences. Okay, and here's the required. The required asks us to prepare the following notes in the financials: PPE and deferred tax. We've started working on this deferred tax note. We're now going to have to include our investment property land and our investment property building into this note building. And that's the work we're going to do today. And then part B asks us to prepare journal entries relating to the shopping centre since acquisition until year end. So there are two journal entries: the acquisition entry and the fair value adjustment at year end. Yeah. And when we do this fair value adjustment, I want you to do the fair value adjustment saying land and buildings. So they like to do this thing where they say investment property land, investment property buildings. Although we know that once it lands up in our notes, it's one column. Okay, so I'm going to leave you to do that, and then we'll debrief. So you need to work through that property, and then you need to do the deferred tax calculation. So where's that property? Sorry, it's over here. So you need to do your calcs on this property. You need to then do a deferred tax calc for the property, and you need to do journals. So calcs, deferred tax, and journal entries. Those are the three things that you need to do. So I'm going to leave you to do that, and then we'll debrief. Okay, let's have a look at that solution. We had done a deferred tax calc, if you recall. Let's look at the journals first. Come back to the deferred tax calc. So with this investment property, we would have started with investment property of 0 at beginning of year. Then there was an acquisition of 23 million, land of 10, building of 13. And then there was a fair value at end of year of 26,500, land of 12.5, building of 14, which then meant that I had a fair value adjustment during the year of 3.5. They asked you, it was a very simple investment property question. They ask you to do the two journals. So the first journal is the acquisition journal. Remember I said to you that I'd like you to do it split. Debit investment property land, debit investment property building, credit bank. Okay, very simple, easy first journal. Then there was a reval or a fair value adjustment. That fair value adjustment goes to P&L. Credit fair value adjustment or other income, it's your choice which one you want to use. Credit fair value adjustment or other income. In the P&L, 3.5 million. The credit goes into P&L, the debit goes to investment property. Remember, I want you to do the split. So the debit of 3.5 million goes to land 2.5 million, building 1 million. Right, so those are your two journal entries that I wanted you to do. The first journal entry, which is your acquisition entry, and then your second journal entry, which is your fair value adjustment entry. And those are the two journal entries which are the required B. Let's just see, required B over here for 5 marks. And I mean, yeah, I think it's worth about 5 marks because it's such easy work. Okay, then the deferred tax. We had started this deferred tax calc last week. We had looked at the machine, the building, and the land, and we had done deferred tax numbers for those 3 assets that are in PPE last week. So our machine was just normal tax, our building was just normal tax, and our land landed up with a capital gains tax. So you see here on land, I only have a temporary difference, which is my movement, my fair value, my reval, and I first times it by 66 before 28% to get my deferred tax. Then here's my land and building for my investment property. Investment property land, the carrying amount at the end of the year is 12.5 million. 12.5 million. The cost of that land was 10 million, but it's exempt, and my temporary difference is 2.5 million. Yeah, so that's also an exempt difference that I would normally not put that in, and I would just say a temporary difference of 2.5 million. 2.5 million again times 66.6 times 28 gives me 466,200. Let's just double check that. 466,200. I think there's a little calculator. No. Oh, it's not here. There is a little calculator here. Let's just do it. Let's just check it quickly. Calculator. All right, so here's my calculator. Oops, what happened to the calculator? Okay, here's my calculator. So it was 2.5 million times 66.6%. No, that doesn't look right at all. Let's try that again. Clear all. 2.5 million times 0.666 is 1.6 million times 0.28 is 466,200. So there's my land. But the land is easy. The land is exactly the same as it was in investment property, in PPE. So land is exactly the same, PPE, investment property, exactly the same. So the building is the one that's a little bit different. So here's my building. My building's value at year end is 14 million. The building had cost 13, and I had done a fair value adjustment of 1. Do you agree? 14, it's at cost 13, and I'd done a fair value adjustment of 1. In terms of tax base, the SARS allows, I think they said a 5%. Let's just have a quick look again. What it says, a 5% building allowances, not apportioned for part of the year. So SARS would have allowed a 5% allowance. So let's look again what that would be. A 5% allowance that SARS would allow, it would be on the 13 million, remember, not on the 14 million, because SARS doesn't look at revals or anything like that at all. So that times 0.05 is 650,000 Rand. And if I take 650,000 Rand off 13,000, it leaves me with my tax base of 12350. So my temporary difference is the 650. It's 1 year of building allowance, which was given by SARS. I don't depreciate land, it's investment property, and so therefore it's not being used. And so therefore that temporary difference is going to be taxed at a straight 28%. If I sell this building, and remember, for deferred tax, I have a rebuttable presumption that I will sell the building. If and when I sell the building, then I will get a recoupment. SARS will say, give me back that allowance. Unless, of course, I sell the building for less than 12,350 Rand. 12.35 million Rand, millions. And then on the above cost piece, so this is up to cost on the left here, and this is above cost. So up to cost is the 13, above cost is the 1. On the above cost piece, I first times by 66.6% and then by 28%. You can see it's not a straight 28 because a straight 28 would have been 280,000 Rand, and then that's the number. So this is the calculation for deferred tax. In your deferred tax, they didn't ask you for the calculation for deferred tax, if you recall. What they asked you for was that they asked you for the deferred tax note. You're going to prepare a deferred tax note. That deferred tax note is basically just going to say deferred tax. It's going to say machinery, buildings, land, investment property, land, investment property, building. That's what the note is going to say. It's going to just say these words here. Machine, building, land, investment property, land, investment property, building. And then it will have these amounts over here. And then it will have a total. And that total, you will say, is a deferred tax liability, because that's what these numbers are. Remember, for deferred tax notes, there are 2 ways of showing the note. You can show by account, which is the one that I'm proposing you do, or you can show by temporary difference. If you show by temporary difference, do you agree that for investment property land, I have 2 different types of temporary differences? I have a temporary difference which is an accelerated building allowance, and I have a temporary difference which is a capital gain. So in that case, then, if I showed by temporary difference, I would have it wouldn't say machinery, building, land, it would say accelerated tax allowances, and it would be all the pieces that are accelerated tax allowances. It would be capital gains. It would be all the pieces that are capital gains. And that's how the note would show. So rather, don't show the note by temporary differences. Rather, show the note by account. And that's the easiest way to show it in this module, by account. And so that's that's us finishing then assignment 1. Yeah, we've been working through the assignment for a couple of weeks now. The assignment asked us for a PPE note, which we completed last week. The deferred tax note, which we've just completed now, worth 15 marks. And then the journal entries for the investment property worth another 5. And look, the PPE note worth 30. That's usually the value of a PPE note in the exam, or PPE in the exam. It can be a third to half of your exam can be PPE. About a third, I would say. Okay, next week we're going to start looking at impairment.